Early lending and borrowing protocols were restricted just like the short tail of assets, so like ETH and USDC and Bitcoin. So we started building Euler as like an integration with Uniswap at the time, actually, to enable people to lend and borrow not just the short tail but also the long tail of assets. If you get liquidated on Euler, because it's a fair auction, the bonus tends to be basically the fair market rate, like however much it should cost to do the liquidation plus a little bit extra. The actual cost of it might be a few $100s, whereas the cost of it on another platform might be literally hundreds of thousands or millions of dollars. When attackers drain a protocol, a lot of the assets come back in terms of like USDC or USDT, right? And Circle and Tether, if they get requests from law enforcement or they know that funds have clearly been stolen, they have the ability to put freezes on assets. A lot of attackers will just effectively auto-convert any stolen funds into ETH or an asset that's like more decentralized and more difficult to kind of freeze, basically. So that's what this guy did. The recovery period where we were tracking down and negotiating the recovery, the price of ETH rallied. And so actually it was kind of like the attacker put on a long position on behalf of all of our users.
Welcome to Epicenter, the show which talks about the technologies, projects, and people driving decentralization and the blockchain revolution. I'm Ryan Creighton, and today I'm speaking with Michael Bentley, who is the CEO and co-founder of Euler Labs, Euler Finance, which is a very innovative DeFi lending protocol. So I'm really excited to talk with Michael about that. So just before we get started, we'd like to share a few words from our sponsors this week.
If you're looking to stake your crypto with confidence, look no further than Chorus One. More than 150,000 delegators, including institutions like BitGo, Pantera Capital, and Ledger, trust Chorus One with their assets. They support over 50 blockchains and are leaders in governance on networks like Cosmos, ensuring your stake is responsibly managed. Thanks to their advanced MEV research, you can also enjoy the highest staking rewards. You can stake directly from your preferred wallet, set up a white label node, restake your assets on EigenLayer or Symbiotic, or use their SDK for multi-chain staking in your app. Learn more at chorus.one and start staking today.
Hey guys, I want to tell you about Gnosis, a collective of builders creating real tools for real people on the open internet. Gnosis has been around since 2015. In fact, it started as one of Ethereum's very first projects. And today it's grown into a whole ecosystem designed to make open finance actually work for everyday people. At the center of it all is Gnosis Chain. It's a low-cost, highly decentralized layer 1 that's compatible with Ethereum and secured by over 300,000 validators. So whether you're building a dApp, experimenting with DeFi, or working on autonomous agents, Gnosis Chain gives you a solid, neutral foundation to build on. But Gnosis is more than just infrastructure. It's also tools that people can actually use. Like Circles, for example, lets anyone issue their own digital currency through networks of trust, not banks. And then there's Metri. It's their smart contract wallet that makes it easy to access Circles, manage group currencies, and even spend anywhere Visa is accepted, thanks to their integration with Gnosis Pay. All this is governed by Gnosis DAO, where anyone can propose, vote, and help guide the network. And if you want to get involved, running a validator is super easy. All you need is one GNO and some basic hardware. To learn more and start building on the open internet, head to gnosis.io. Gnosis, building the open internet one block at a time.
Cool. Thanks so much for coming on, Michael. I'm really excited and looking forward to this one. I'm curious, tell us maybe a little bit about yourself and how did you get into crypto first?
Yeah, so first, thanks for having me on. Looking forward to it. How did I get involved? Well, I used to be, before this life, I used to be a research scientist. I used to be an academic. My specialism was evolutionary game theory. So I used to do like lots of population modeling of biological systems and how they change over time, effectively. I was more on the math side, but I used to collaborate a lot with like computer scientists and biologists and other people. I started as a bit of a crypto skeptic when I first heard about it in 2015. Didn't think it sounded very cool. I just mistook Ethereum for like some kind of boring database like solution or something. I just wasn't interested. But by 2017, like maybe late 2016, early 2017, like the markets had kind of got a bit frothy, and I got drawn in at that time and started. I think later that year I started building trading bots and things for some of the primitive decentralized exchanges at that time. So something called IDEX that I used to trade on, and Ether Delta. I don't remember that one. These were like literal order books on Ethereum. So quite slow and quite clunky, but they were kind of like a good introduction to like markets and how Ethereum works and stuff. And then yeah, stuck around as things like deteriorated in terms of the market conditions over the next few years, and got more interested in a bunch of other stuff in 2019 and early 2020. Like DeFi was sort of starting to emerge as like this kind of force to be reckoned with. There was like Uniswap and Yearn and things like that were becoming popular, and that's when I got sucked in and started studying interest rates and things. And so I actually started Euler off the back of doing a hackathon project where I'd created a novel interest rate setting mechanism that was more decentralized, so like less dependent on third parties than the ones that were being used on Compound at the time.
What was the original vision for Euler?
So we wanted to make something where you could lend and borrow any asset. A lot of the early lending and borrowing protocols were restricted to just like the short tail of assets, so like ETH and USDC and Bitcoin, and maybe a handful of others. And yeah, I guess in my hackathon, I was sort of inspired by like how do you set interest rates if you want to expand that set to like everything? You need an interest rate model that can adapt over time and adapt itself. You don't want necessarily like a slow process of governance or third party like changing interest rate models. So we wanted to see, could we let lending and borrowing happen for anything? And so we started building Euler as like an integration with Uniswap at the time, actually. So Uniswap V2 had oracles for an inbuilt oracle for the value of assets. We plan to use that to enable people to lend and borrow not just the short tail but also the long tail of assets. Create lending and borrowing markets for all things. Didn't actually work out like that. We had to pivot a few times as the project grew, but that was one of the early visions, I think. Yeah.
Okay. And then I'm curious, is this? It sounds like something where maybe your evolutionary game theory. Was that background knowledge very applicable here?
Oh, I mean, massively, right? It's yeah, I mean, in that day job, you're often like, what was it actually doing? You know, how do you build these models? You like consider like a set of things or entities, people, biological organisms, and they're like kind of playing strategies in this big like competitive game, and they interact a lot. And so you have to like model that out and think, you know, what would be the like equilibrium state of if you've got like two different entities playing different strategies, right? And that's very similar to what happens in markets, right? You have like lenders and borrowers. You have like people striving to like optimize profitability or optimize some kind of metric like risk adjusted return or whatever. And so yeah, there's a huge amount of overlap in terms of designing a DeFi protocol that can facilitate like markets and designing a model about how populations change in response to their environment. It's yeah, if you just abstract everything, then it's actually very, very similar kind of task. So yeah, it was definitely my background was very relevant to what I do now.
So I imagine you're pretty unique among DeFi protocol founders having like that kind of perspective and background. Do you think that, did that just help you maybe design Euler in a little bit, have better models for different risk events? Or do you think it also ended up, just in a different protocol design because of that background you had?
I think it's I mean, yeah, I mean, DeFi founders tend to come from really varied backgrounds, right? And there's like trade-offs to having different to all of those backgrounds. You know, like I think famously at Euler we're very like engineering driven, and a lot of the things that we build are like really strong on the engineering front and well architected, and so we have like very strong attention to detail to like low level processes and mechanisms and things. So like for instance, liquidations on Euler. I think we have the best liquidation engine in all of DeFi. A lot of liquidations when they happen on other lending borrowing protocols, effectively the borrower just has like some of their collateral like slashed and sacrificed, and then that's used as a reward for the people that are performing the liquidations. And it's often really costly, really costly, especially if you're a big borrower. You've got like, tens of millions of dollars at risk. These bonuses, these kind of slashings can be, and they can be worth like hundreds of thousands of dollars or millions of dollars. On Euler, we use a different mechanism, so we don't take like a fixed amount of the collateral. Instead, we have this like auction that plays out. It's a Dutch auction that plays out on the bonus that's distributed. What's neat about that is that if you get liquidated on Euler, because it's a fair auction, the bonus tends to be basically the fair market rate, like however much it should cost to do the liquidation, plus a little bit extra to kind of justify it. And so, like the equivalent, if you're a large borrower on Euler and you get liquidated, the actual cost of it might be, I don't know, a few $100s, whereas the cost of it on another platform might be literally hundreds of thousands or millions of dollars. And so that like process, that like focus on auctions and how they can drive efficient outcomes, I think was like very much driven by like who we are as builders at Euler, which is effectively just a team of engineers or scientists. All of our backgrounds have like a strong influence over how Euler's architected. I think it's certainly always been a bit different to other platforms in that regard.
And so the high level vision then where you guys ended up was basically like a lending protocol where you can borrow like any asset and use any asset as collateral. That's kind of the...
I think that was the original vision, and then as we adapted, as we grew over time, we realized actually allowing anything to use as collateral is there are other like factors that come into play, right? Like even if you could do that, you need to find like counterparties who are willing to take the other side of that trade. And the truth is that there's just not a market for that. Like I'd love to use my like long tail meme coins or whatever that I've got in my wallet as collateral, but who wants to lend to that? Like who's going to take the other side of that trade? There's just not really anyone available. And it's kind of like, that's true in real life, right? Some assets just make really good collateral, and you can go to a bank and say you want to take out a loan against a certain stock portfolio or a house or a car or whatever. But some things just don't make for good collateral, even though their paper value might be quite high. It doesn't mean that they're strong collateral. So yeah, I think there were a lot of learnings we made in those early years as well about like actually there's certain things you can technically do, but whether or not they have like product market fit is a very different question.
So if you kind of go back to sort of the history of Euler, right? So you talked about this hackathon and then how it evolved into this vision of having this very flexible lending protocol. I know at some point you guys had a big hack. I don't know when did that, or like, can you tell a bit like how did things progress from that point onwards?
Yeah, so we there was a big exploit unfortunately in 2023. So it was actually at the time when the Euler protocol being like growing very rapidly and taking market share from incumbents at that time. Euler V1 was like a very, very heavily audited platform. Like we'd had more audits than most people. We worked with Satora who do formal verification. We had the largest bug bounty of anyone in that kind of vertical. So we took security really seriously. But what happened effectively was that we had this bug bounty open, and somebody came and reported a pretty minor bug on Euler. So there's this smaller issue that first depositors whenever you open a brand new market, the first depositor has some funds at risk. And because it was a funds at risk bug, we awarded them a bounty, a pretty small bounty, because the amount of funds at risk wasn't huge. But because there were some funds at risk, our security partners, when we talked to them, said, yeah, you should probably fix this, right? So we developed the fix, and it looked good on paper, and we had it re-audited. So we were with our security partners; they audited the fix. But I think ultimately the fix, probably when you do a full audit the first time around, you're considering absolutely everything. You're not just looking at a small part of a protocol. And so when full audits are fantastic, right? But when they were auditing this smaller fix, and when we were developing this like solution for this much smaller issue, it was much more of a contained, it was more like a focus on that thing, and we weren't, both ourselves and the auditors weren't seeing that bigger like holistic vision. And it turns out that by developing that fix, we'd actually inadvertently introduced a much more fundamental error, or much more fundamental issue into the protocol. And that's how 9 months after we deployed that fix, somebody was able to come in and effectively exploit a large amount of funds, and take a large amount of funds from Euler V1, which brought down the entire protocol.
What was that error that you guys introduced?
So the solution to the problem, just very briefly, I mean, the problem itself was caused by an uninitialized exchange rate. When a brand new market's created and there's no users yet or anything, there was one exchange rate between the receipt token and the deposits that was uninitialized. It turns out that for technical reasons, an exploiter could potentially front run a deposit if they set up a bot or something. They'd have to do quite a bit of work for it, but potentially they could like front run the first deposit and only that deposit, and then use that to take some of the first depositors' funds. So the fix that we developed was, well, why don't we take the first depositors' deposit, and we will, before they actually add the deposit to the account, we'll use like 1 way or like some really small amount of that deposit to initialize the exchange rate. So there was this function that was added to the code base called donate to reserves, and the donate to reserves function was only intended to be used as a way to initialize this exchange rate, and first depositors wouldn't even know it's happening. Now, what it turns out, so what someone realized, unbeknownst to us, was that you could use donate to reserves as a borrower. If you donate your collateral to the reserves, if you do it in some unique circumstances, you could drive yourself towards like a less collateralized position. And then if you can force yourself into a liquidatable state, you could then lose money and liquidate the account, right? And so you might be thinking, well, why would anyone want to lose money? It turns out, we talked about those liquidation bonuses earlier. Turns out that there was some like parameter space effectively where you could lose less money on the liquidatable account than you could make as the person liquidating. So the person liquidating would get the bonus. And so it wasn't a huge difference, but it doesn't need to be, because it turns out that the attacker could then effectively kind of like loop to amplify both the losses and the gains. And so with this looping strategy, they were able to withdraw a lot more, drain more funds from the protocol than normally it would allow. And so that was that's how it happened.
What was the like TVL back then, and how much did the hacker manage to steal?
So we had, I think total deposits were sort of around 500-600 million. The attacker was able to take out 200 million from the protocol. Yeah, like big numbers. And I can talk about like the recovery process, but we did, I should say upfront, we recovered all of the money and more. So we were able to recover 240 million from the exploiter over a period of several weeks following the attack. So we were able to track them down and negotiate the return of all the stolen funds.
Oh, so yeah, to tell us about that. Like, how did you guys track the guy down, and why did they agree to return these funds?
There could be an entire, like, I am not kidding, like an entire documentary series on this exploit. It's one of the most harrowing moments of my life, but also retrospectively now, if you look back on it, one of the most interesting sort of the exploits in DeFi history, I think. So I mean, firstly, the reason it was particularly awful, I mean, it's awful for everybody involved when something like this happens, but for me personally, it was only 4 days after the birth of my son. So I was on, like the weekend. My son was born at like, the early hours of Friday morning. By Friday afternoon, there was a banking crisis in the US, and Circle asset USDC was depegging. So I was called into action to like deal with this crisis issue with USDC over the weekend. So I didn't really get a chance to spend any time with my son then. And then on Monday morning, I had some alarms going off, and I assumed it was related to the USDC depeg event, but it turns out it was actually an Euler specific attack. And so the next few weeks were then spent with him, my son, like in the background, and me like trying to negotiate return of all this money. There was so many twists and turns. The exploiter like tried to we track them down through various means that I can't really reveal all of them, but you have to do a huge amount of data gathering and
so because you figured out the identity of the person.
Eventually, yes. Although not initially. I mean, we had I think we had a list of around 10 candidates. Can't remember, but like we developed a list of people that we quite quickly over about 24 hours. We had a list of people that we thought could be involved based on available evidence. And but yeah, we didn't actually know the identity of the person until quite a long time after. Like even when we first started talking to them, we wanted them to believe that we knew who they were, but we didn't actually know which person they were out of our list or whether they were on our list at all. In fact, but yeah, they started getting. I mean, they tried to do a donation to a North Korean address to make it look like it was a North Korean exploit, because if North Korea exploits a protocol, the funds don't come back, right? You don't. Then they're gone forever.
You don't negotiate with North Korea.
No. I mean, so it's over. So I suppose he was his gambit there was, hey, if they think it's North Korea, then maybe they'll just like go away. But at that point, there was already like strong indications from our side that we knew it wasn't North Korea. So we were kind of able to call his bluff on those donation gambits, and then try to provoke more of a response from him, and then try and just get closer and closer whilst trying to negotiate the return. And then the funds started coming back in dribs and drabs. It wasn't like they all came back in one big block. Actually, they came back in maybe batches of like, I don't know, maybe like 8 different times, like different amounts of funds like would come back, and he tried to play games like trying to pretend to be multiple attackers at one point, and do all sorts of like really crazy stuff. So it was a wild goose chase, and it lasted for weeks.
Wow, interesting. And then in the end, you said you recovered more than what he had stolen?
Yeah, and I mean in dollar terms, because when attackers drain a protocol, a lot of the assets come back in terms of like USDC or USDT, right? And Circle and Tether, if they get requests from law enforcement or they know that funds have clearly been stolen, they have the ability to put freezes on assets. So a lot of attackers will just effectively auto convert any stolen funds into ETH, or an asset that's like more decentralized and more difficult to kind of freeze, basically. So that's what this guy did. And then in the period of the recovery period where we were tracking him down and negotiating the recovery, the price of ETH rallied. And so actually it was kind of like the attacker put on a long position on behalf of all of our users on ETH. Yeah, whilst it was going up in price. So when we finally recovered all of the funds, the users got back. There was a surplus, a $40 million surplus of assets, basically. So yeah.
Wow. So then you guys paid that out to the users, or how did you?
Yeah, I mean, it was all paid out to the users. I mean, it's a very complex calculation, figuring out how much users have in a protocol. A lending borrowing protocol, like the users have like a net asset value, right, at a snapshot point in time, but that net asset value changes a lot over a period of 3 weeks. That can, depending on what kind of positions you got. Have you got loans? Have you just got deposits? You just lending and so on. But yeah, it was all distributed back to the users. So that was the recovery period, which itself took a long time and was very, very difficult.
And because the TVL went down to pretty much zero, no? Or
I mean, the protocol wasn't viable after that had happened. I mean, yeah, so it wasn't like there was. It wasn't like there was a live protocol anymore. It was basically a dead protocol. So it had to be the option was effectively. It turns out, by the way, that there was the way to prevent this was like there was like a single thing missing from this donate to reserves function. The donate to reserves by itself wasn't the biggest wasn't the issue. It was just there was a missing like check in this function, and so had that function had the missing check, then it would have been fine. So in principle, at that point, we could have just, if we wanted to continue from there, we could have just made that fix to donate to reserves and then relaunched Euler V1. Because it was a very good protocol, and I think there's actually a fork of it somebody else has been using on one of the other networks. I forget its name. That's been going strong ever since. So yeah, it's a very good protocol aside from that one crucial flaw. But we decided for other reasons actually to not go with relaunching V1. You know, we decided as a team to stick together after that. It took us a while to come to that decision, like a few weeks, but you know, once we were all,
did you guys also think of like just shutting down, or?
Oh yeah, of course. I mean, it was extremely traumatizing for the team, and obviously going to be really hard to recover from that. But we had a very good reputation in DeFi, I think, up to that point. You know, it wasn't like this had happened out of carelessness or because you know we hadn't got the audits or whatever. We were like we went above and beyond at the, you know, with all the gold standards at that time were kind of followed, and so we had a lot of support from the broader DeFi community and from the security community and so on to continue. And the question was, could we restore the faith of like potential users though, right? Like it's one thing having a security researcher say, well, yeah, they you know they did their best and still this happened, but it's another like finding that faith with the users again. So there's a lot of concern, I suppose, that like even if we wanted to, we wouldn't be able to come back reputationally from this. But yeah, we talked about it a lot and decided that we all liked each other and wanted to work in DeFi still and try to keep moving the space forward, and that we had kind of a special team. And so we thought we would, rather than disperse and go and like join new projects and try and rebuild a new project, we thought we'll give it a go. We still had the finances to do it, fortunately, from our investors, and we had the backing of all of our investors to go out and rebuild. And so yeah, we said let's give it a shot. And so that's how we started building Euler V2 at that point.
And what were the biggest changes in V2?
Yeah, quite a lot, to be honest. I mean, V1 was we had a lot of we learned a lot from V1 about like the market and the product market fit. Like we discussed earlier about, you know, what is it, like it's one thing to just build something, but like does it really have demand? The main thing we learned, I think, was that there's not just like a one size fits all in DeFi for lending and borrowing. Like every single user has a slightly different risk reward preference. You know, some people like really conservative, like simple markets that are lower yielding, but they do one thing and do it really well. Others like things like Aave, which are more like larger monolithic protocols, probably like more capital efficient, but like with an elevated level of risk. And so like it's not clear that there's just this like one perfect way to do credit markets that fits all users. There's a diversity of preferences, and so we thought, how can we, and by the way, also like an increasingly like diverse number of assets as well. So there was like lots of, you know, new stable coins and like stake teeth and things were emerging and so on. So lots of different asset types. And so what we realized was, rather than building like this one protocol that's like designed as a particular product for a specific user set, we said, why don't we build the infrastructure for making credit market products? So we decided to build more of like a modular protocol where you could have these like plug and play pieces that you could fit them together effectively to then rebuild products. And so you can rebuild Euler V1 using this toolkit that we've got for Euler V2, but you can also build other types of credit markets as well that might have a different design. They might be more conservative on the risk spectrum or whatever. And then the idea with V2 is that other people can then come and build products in their own image and tailor them to the user bases that they have in mind and the risk reward demands that they have on the protocol. So Euler V2 is not a product, a single product. It's like a rainbow of products. There's just all sorts of different types of things going on with V2 and different operators as well for those products. There's lots of entities called risk curators or curators that come and build their own credit markets in Euler, and that wasn't really something we had in V1.
So does it make sense to think of like today, if you think on like lending credit protocols, you have like Aave, that's, of course, the best known, and which is a, very simple protocol. And then I guess Morpho is a bit more flexible, and then you guys are even more flexible and even more modular. Is that like a reasonable way of, or like, how do you compare Euler sort of in the landscape of different DeFi lending protocols?
Yeah, I think I would say, like, at its core, it's a toolkit for making DeFi protocols. So you can build Morpho with Euler, or you can build Aave with Euler, or build something in between those two. But that's not true the other way around, right? You can't build the primitive using their toolkit. So like Morpho fundamentally has these things called markets, and markets in Morpho are just like collateral debt pairs. They're simple isolated pairs. And then they have many pairs, and then on top they have allocators. So capital allocators will then push capital into the different pair markets, and borrowers will borrow from those pairs. Aave, by contrast, is this big monolithic market. So it's a market, but it's, rather than having just a pair of assets, it's got 30 or 40 assets in it, right? And they're cross collateralized and so on. So it's more capital efficient, but higher on the risk spectrum, because now you don't have this. You don't have this isolation, essentially. So if an asset
it makes it more capital efficient, because basically Aave has like one pool of USDC, and and there's like one borrow rate, and versus, like, for example, Morpho, there will be like various different types of USDC pools, and maybe some are like used to the max and some others are barely used.
Exactly,
and that kind of, yeah.
Yeah, so on Morpho, I mean, just like if you think about the design trade-offs there a little bit, like there's fragmented USDC pools. Now Morpho tries to solve that for the lenders by effectively having like a higher level allocator vault. So most lenders deploy into their like allocator vault, and then that disperses those funds into these lower level markets. And that's fine for the lenders to a degree, but on the borrowing side, it still means you have this huge amount of fragmentation, which leads to like variable rates and less capital efficiency there. The other thing about Morpho is that the collateral is always held in like an escrowed state, which means it's not rehypothecated at all. In Aave, the market's cross-collateralized, and often if you're taking a loan, let's say you're using ETH to borrow USDC, the ETH is rehypothecated, which means that somebody else can be borrowing the ETH from you whilst you're using it as collateral, and that makes it more capital efficient, because if I'm borrowing USD on Aave or a rehypothecated market, like we have on Euler as well, it means that I'm earning interest on the ETH side, and I'm paying interest on the debt, and like sometimes the two cancel each other out. Sometimes it's actually even profitable to kind of take loans like that. Whereas on Morpho, your ETH would typically just be sat in kind of escrow, and it wouldn't earn extra yield, so it might cost you more. If you look at what's called the utilization rate of these markets, which is like the average, if you look across all possible positions, of like the amount of basically the fraction of assets which are borrowed on Euler, the fraction of assets which are borrowed is around 50% or above. On Morpho, by contrast, it would be like low 30s. So there's a big gap between the capital efficiency of markets which have rehypothecation or enable that as a feature, and the ones that don't. And that's one of the trade-off and design decision differences between Euler and Morpho.
And so Euler, you also have rehypothecation like in Aave.
Yeah, so on Euler, our primitive unit is not a market, but actually even smaller than that. It's just a single vault And users can deploy assets into vaults, and then they can use those assets as collateral, or they can lend and borrow them from the vault. Now, if you want to recreate a morpho pair, you basically connect two vaults together. You have like one vault which does the lending and borrowing, and one vault which just holds the collateral. It's got a single connection. But on Euler, you can, because it's a toolkit and it's the modular toolkit, you can actually extend that. You can say that I'm going to accept multiple collaterals, and then I'd have like different types of collateral for my lending and borrowing vault. But you can also do the relationship both ways. So you can say that A can borrow B and B can borrow A. So if you start to build up markets where you have lots of vaults which all cross-reference one another as collateral, that's effectively what RWA is. So yeah, under the hood, you can reconstruct an RWA. The simplest possible RWA would be something where you have just, people can deposit ETH and borrow USDC, and people can deposit USDC and borrow ETH, right? That would be like the simplest possible RWA with rehab application. There's a protocol called Silo which allows those kind of markets to be developed, and Euler has those too, right? We have some markets which are just that simple. They're like the simplest possible RWAs. But we have some markets where there's also many assets, and they start to, the market gets much bigger and starts to resemble more like RWA itself.
And where do you see the most traction today?
Mainnet, in terms of networks, we're deployed across 12 different networks, and ETH mainnet, I think, is the home of finance today, or the home of DeFi today. But we've got a lot of traction on Avalanche more recently as well. Recently deployed to Linnea, which is growing quickly, and Arbitrum. It depends on which network you're on, what the asset base is there. That all users have different profiles and different networks, we found, and so you see very different types of markets developing on different networks. Stable coins, yield bearing stable coins, and stables more generally has been the thing that's driven the explosive growth of both Euler and also Morpho, I think. There's just a diversity of yield-bearing assets and demand to borrow.
So yield-bearing stablecoins where people will deposit the yield-bearing stablecoin and then they borrow against it.
That's right, yeah.
So like USDE or what are the top yield-bearing stablecoins in Euler?
I think USDE will be like a massive one. We also have like some OpenED and stuff as well, lots of Pendle tokens. So, I mean, the basic trade that's super popular these days on Euler and other lending protocols is you deposit your yield-bearing stable, let's say it's paying 10%, and then you borrow a non-yield-bearing stable, but from a lending market, and maybe you have to pay 7% to borrow. So, if you...
And
what
then
you
you
can do,
loop that.
And then you loop that, so that you, rather than getting just your 10%, you can effectively earn the 10% plus the number. You can get that 3% or 4% spread, but on a loop. So you amplify your exposure to the interest rates, and you take on board risk if the stablecoin depegs and it falls in price, your collateral decreases in price, and you risk liquidation. But assuming you're not worried about that risk, then you can effectively amplify the interest rate you earn by kind of looping a yield-bearing stable against a non-yield-bearing stable and try and perform what's called like a carry trade. It's very popular in TradFi as well as DeFi, but like in DeFi, this has been the big trade of the past year, I would say, is some kind of carry trade on yielding, non-yielding stables.
What do you think the future looks like? I'm curious. I mean, I guess in the traditional financial market, right? Like fixed rate lending is a huge part. I mean, I would guess probably a majority of that is fixed, although you probably know better what the breakdown is there. Whereas in, I think, DeFi, right, we have vast majority of lending happens with variable rates. Do you think this is going to change?
I think it will change, yeah, for sure. I mean, we've got new products coming on Euler, which are more targeted to fixed rate borrowing. We've got two products coming actually in that regard, but we're not alone, right? I think the other competitors have products coming too. The reason why they're in such huge demand, I believe, is that It's not so much, lenders probably fairly happy with variable rates, right? The variable rate is probably the fair rate that you should be getting at any one point in time. The rate reflects like the demand to kind of borrow in the market, and then like compensation you should get as a lender based on the risk that you're taking at that time. So I think for lenders, they're fine with it, but for borrowers, these carry trades become a bit unwieldy to carry out if the thing you're borrowing is very variable, right? You might have your yield bearing stable that's at 10%, and yeah, maybe you start and you open up a trade and you're borrowing at like 7% or 8%, but then the rate spikes. Now it's actually more costly to borrow the thing than the thing you're using as collateral. So now you're in like this negative carry trade. Where you're actually losing money on a loop as well. So you're actually like amplifying your losses. And so that's borrowers are getting increasingly frustrated with that, right? They would much rather maybe pay a premium initially to kind of lock in at a fixed rate. So maybe maybe the variable rate pool's 7%, but maybe they're happy to pay 8% as long as they know that they can lock in and it won't go above 8%. So huge demand on the borrow side, I would say, for borrowers to be able to lock in fixed cost borrowing positions for short to medium term amount of time.
Okay, and then I guess on the lender side, they would also then accept or have to accept the fixed rate.
Yeah, and this is the question, right? Are the lenders going to be just as happy with this? The fixed rate products are definitely favorable for borrowers. Are they favorable for lenders? And do you have product market fit on both sides of the plane here? I think on the for lenders, they would expect a premium, right? Because they're also sacrificing sacrificing this like fair rate that they're getting. The borrower should be prepared to pay this premium because it's clearly providing an advantage for that party. So they're effectively trading like they're playing a premium to like lock in a profit. So yeah, that premium goes to the lenders, and maybe that premium's enough, but maybe it's not. The other thing the lenders forego, I guess, is that flexibility to withdraw. A lot of lenders lenders like to have that flexibility to just like withdraw whenever they want, right? A lot of lending protocols are designed with that in mind. So they often have this unutilized portion of the pool or idle capital in the pool, which allow the lenders to withdraw at any one point in time. If you lock in at a fixed rate, however, you typically kind of get locked into more of a fixed term as well, which means you're losing that flexibility to access your capital when you need it. So yeah, there's that like clear tension between lenders and borrowers, and one thing we know is that markets are a really good way to like find like a resolution for that tension. So it'll be interesting to see when these products ship. I think it sounds like all protocols are developing slightly different types of fixed rate products. It'll be interesting to see which ones get the best product market fit and satisfy the needs of both the lenders and the borrowers in a way that's like kind of balances out and is fair.
Do you think the demand on both sides will be mostly sort of short, like, I don't know, a month or maybe even shorter duration? Or do you also see markets developing for more long-term debt?
I think initially it's going to be driven by most borrowers are kind of like traders, and they're working on like time horizons that are like months, not usually years. As a borrower, if you're doing these strategies, you could in principle be like rebalancing every day. You can probably optimize yield by like finding the best strategy every day, or rebalancing very frequently. But then you have like the cost of rebalancing, right? Which is not just it is like gas costs, but like your time, like planning, like then the added risk of like repetitively rebalancing, like you might make a mistake in one of those things. So rebalancing too frequently is kind of not something people tend to do. So yeah, usually borrowers, like, in my opinion, will be looking to lock trades in for weeks or maybe like several months at a time. So yeah, we see this kind of thing with Pendle, right? Pendle offers fixed rate products and allow borrowers typically or like more like lenders, I suppose, to kind of like lock in for 3 month to 6 month periods as well. And I suspect we'll see fixed rate products that kind of match that sort of time frame. So that like 1 month to 6 month sort of range will probably be where I put my money on being the most popular.
So you mentioned Pendle, right? I mean, Pendle is another DeFi protocol that has gotten like a lot of traction. I mean, my understanding of Pendle is that it's a lot of around, points and basically, someone will earn some unknown amount of some other token, and then they basically sell those for like some fixed interest, and then they get these PT tokens out with a specific maturity, and I guess they could then use that as collateral in something like Euler to borrow and to loop it.
Yeah, exactly.
Would you also think, or I don't know if it's possible to build something like Pendle directly in Euler?
It would, yeah. I mean, you could definitely do that with the kind of fixed rate products we've got coming. But like you say, I think Pendle's are exceptionally powerful is by it allows people to effectively convert intangible like incentives and rewards into like a concrete fixed rate. So you have people earning points and other things which are like quite hard to value. And so they don't really know what they're worth, and they like sell them off for kind of like lock-ins and like for like make it real, basically, like make those points real and turn them into like something that they can actually trade on a proper secondary market. And that's where like Pendle services that need. As you said, then once you've converted that into a kind of like a real kind of yield, then people want to loop that yield and like amplify it on places like Euler, where they'll come in and collateralize a Pendle token and do a carry trade and borrow non-yielding stables there. The loopers end up being kind of like junior capital. They're like seeking higher risk, but like seeking more reward, but taking on higher risks, liquidation and performing all these loops and all the rest of it. And then the lenders on the other side of that trade become more like senior capital, where they're not getting paid as much, but they're kind of protected, and they're protected through effectively the over collateralization of the borrowers. That's been the big popular trade, I would say, on that front. But you could build Pendle in Euler, but it's not like where there's no plans to build that Pendle like product in Euler, frankly. It's a different kind of fixed rate that I think people want to lock in for.
What do you see as the future for Euler?
I mean, I think all of finance is coming. So I've been saying this for years. I think all of finance is going to come on chain. I think if you use swap products and you're a swapper, you have no loyalty to who you use, right? You just put it through 1inch or CowSwap or whatever else and just get the best possible swap rate you can. But on credit markets, people don't do that, right? There's not going to be one winner. There's going to be a diverse selection of protocols, because people want to diversify the risk. If you're putting assets into somewhere or taking out loans over extended periods, you're exposed to extended periods of risk. And there's this saying, right, that the only free lunch in finance is like diversification. So I think Euler is going to be one of the largest credit protocols in the future of finance, frankly. And I think we won't be the only one. There'll be other big protocols too, but certainly we'll be up there. And over time, I imagine that we'll all slightly specialize. Usually what happens in markets is you find specialization. So Euler will develop a specialization for certain classes of trades probably, and do those better than anybody else, whilst the other competitors end up specializing on other things as well. Yeah, in the short term, I think right now we're still dealing with very crypto native forms of like credit, but I think there's increasing amounts of more traditional forms of credit coming on chain, and I think Euler is very well set up as the architecture of Euler is very welcoming for real world assets, I would say. And so that's something that I think we'll be pushing forward on in the months and years to come.
So you think, in terms of, you mentioned that different protocols will specialize in different ways. So you think for Euler it will be more around RWAs?
I think real world assets will be a big part of it. Yeah. We also have like a swap protocol that's built on top of Euler, EulerSwap, which works extremely well with real world assets and can open up growth opportunities for real world assets that aren't really there today. So yeah, I think that's something that we see as like a competitive advantage, certainly.
So when you talk about real world assets, what do you think are the type of real world assets that will get the most traction?
Well, there'll be in the short term, I think like DeFi has always been a very risk-on environment. So I think like tokenizing credit funds will be popular because they'll generate more yield. And those yields then will get passed on to lenders through looping, where we get like senior, junior tranches, just like we have with the DeFi assets today. I think initially
But that's like
where
credit funds, where people basically, I don't know, for example, lend a fund that lends dollars to, for example, businesses, like that kind of thing, and then they somehow like tokenize the fund and put it on chain.
Yeah, that's right. Yeah, I think those kind of things they're definitely higher up the risk spectrum. But that's the kind of DeFi is a very risk-on environment generally, and I think like with the people we have here today, that will probably be quite popular. But over time, I think the space will continue to mature. We see like all sorts of fintechs coming on, and more like traditional institutions coming on chain as well, and so then we'll start to see the emergence of much lower risk types of real world assets coming on chain and being popular as well. I mean, there's already some of those here today, but they're just not widely used, right? We like see Biddle. It's tokenized T-bills, all those kind of things. Like they don't provide juicy yields, and therefore they're not that popular to trade among in DeFi protocols today. And there's friction to using them as well. There's like extra constraints with moving these assets around. Euler and EulerSwap helps lower those frictions. I think makes them more efficient. But even with those efficiencies, you still need the types of people that want to trade those assets. In TradFi, you have like repo markets and money markets and things where you see like really large sums of money like changing hands over like short periods of time. And there's just nowhere near enough liquidity in DeFi today to support those kind of trades. But increasingly, that's changing. I think that will be very popular in the years to come as the space matures.
I know one of the things that was often discussed as a big bottleneck to getting more financial institutions on chain is like privacy. What do you think is the role of privacy in the future of DeFi?
I think it's going to be it's an interesting one. There's a huge tension, right, between the desire for privacy, but then the desire for transparency as well. And where you sit on that spectrum, I think depends a lot on your own personal background, like your experiences, like how you think. It's more like a political thing, right? I mean, I think if you look historically at like protocols that have provided like a really high degree of privacy in DeFi, it's been fairly heavy use of like illicit finance by bad actors, and that puts traditional finance off. Actually, like then you're not going to see institutions mixing funds with illicit funds that were taken in hacks and like mixing with other sorts of illicit finance. So that's one form of privacy that's I think it's going to struggle to get adoption, honestly. But on the other hand, institutions also don't want you to always know what they're trading, right? Like especially if it's a directional trade, I don't want to be putting on a trade on Bitcoin or whatever else and let everybody else just like pick me off because they can see that I'm long and I've got certain types of exposure. So there's a huge tension, and I don't know where it will resolve. I don't think it's not that we don't have the technical capabilities to make these protocols. It's more of like a political thing, and how much should we trade off between transparency, which tends to make like fairer markets, versus privacy, which is like arguably fairer for individuals and their personal freedoms, right? yeah, I just don't know. In like most regulations in TradFi seem to be driving towards more transparency, not less. But if you ask any individual person, like, should I have more privacy? I think most people would want more privacy, right? And that's only right. So yeah, there's this huge societal and tension there between those two things.
Yeah, and I guess the other thing, I mean, maybe that is a solvable issue, right? But of course, one of the advantage of DeFi on the transparency of DeFi is also much easier to assess where the risks are.
Yeah.
I mean, hard enough, but at least the information is there and someone can try to do it. But then if you add more privacy, that probably also makes it much harder to understand where the risks are, and if this fails, what else does it result in?
Yeah, I mean, I entered the like labor market in August 2008, and I joined a bank in the UK called the Royal Bank of Scotland, just as the entire system was like collapsing, right? And I remember hearing from that, after people like went through everything afterwards, and I tried to like piece it all together, and it was just like an absolute nightmare. And I still don't think people completely understand what happened, because like actually mapping it all out and looking at when all these different banks collapsed and everything, like what actually went wrong, what was the trigger, and like where were the funds flowing, all the rest of it is very hard to like process it. And I think that at least in DeFi, that's all easily mappable on chain, and if someone wants to do it, they can. It's not necessarily like easy, as you say, but it's much more transparent in that regard, and I think that will be healthier for financial markets in the long run, even though it does pose its own challenges. There may be, we may yet see technologies emerge which actually are able to kind of balance that tension out, where you can kind of have like privacy is like the de facto norm, but like it can you can like under certain conditions like reveal certain things or whatever if it's essential to do so, to make sure that you aren't like mixing funds with illicit finance and so on. But I don't know. I mean, it's not something that I'm working on personally at the moment. We're working with what we've got, which right now is mostly like max transparency, I would say, on open public blockchains.
What's your biggest focus right now?
Ooh, I mean, personally, we have new products coming. We've discussed on the fixed rate side. We've been working on growing our swap protocol, and from my side, like a lot of my time is spent like going and meeting new types of users, like institutions and other people, that and talking to them about how Euler works effectively, and educating them about how the system works, and seeing if they can be encouraged to come and use the protocol, new types of asset issuers and so on. There's just almost not enough hours in the day at the moment. Like there's just a massive shift in the past year, and growth opportunities absolutely everywhere in DeFi right now, I'd say.
What do you think about the impact AI is going to have on DeFi?
Ooh, I mean, as we mentioned, I think like one thing that's certainly likely to happen. We've talked about like rebalancing strategies and all the rest of it, and making sure that you're able to kind of monitor positions and so on. I imagine that that's something that's going to be handled by AI. We've already like internally like played with some like machine learning algorithms for like optimizing yield, basically by like rebalancing like lending positions and so on. I think you could do that with AI as well. Like have like smart borrowing, basically, where you, rather than you having to sit at the computer and like with all your spreadsheets, like the the financial analysts going through things, poring over data, like write really intelligent bots that can basically, under some constraints, move the funds on your behalf to either optimize the yield as like the senior tranche, or to optimize the lending and borrowing positions as the kind of junior tranche of things. So I think that will be, will change things a lot, and lead to more efficient markets overall. There's huge inefficiencies in DeFi today. Rate optimization is not really a thing. There's protocols like IPOR and others, and that do it. Like it's the kind of what Yearn introduced, like when I first started back in 2020, like I think we're doing this kind of thing, but it's still a very inefficient market, by and large. I think AI is going to change that.
Cool. Well, thank you so much for coming on. It was really cool to dive into Euler. And yeah, I think what you've pointed out before, like, with TradFi and RWAs coming on chain, a lot more capital coming on chain, this is going to be I think DeFi will continue to be an extremely interesting space. So I'm really excited for what you guys are building.
Thank you. Yeah, thanks for having me on. It was a really good chat. Lots of different topics. It was great. There's just so much to do right now. It's a very, very exciting time.